All right, Lena, take us in here.
No, it's not
Kev,
Lena. Oh, sorry. 1 second. I didn't mean to interrupt there. Try it again. Let's just go from here. Let's just run
okay.
it. Okay.
Yeah, yeah.
No. I want Lena. Leave this in. Let's go. Come on, Patrick.
Okay, Kev, understanding the steepener. So many of our listeners have been following you, and so obviously there's a lot of people out there that talk about the bond markets, but there's different ways to trade it. I mean, there's obviously those that play directly long, but then there are those that play the shape of the yield curve. And as interest rates are changing on different parts of the curve, often it's a far less risky proposition on playing the way the curve will shape as opposed to taking direct exposure into the bond markets. Am I summarizing that right,
You,
basically?
you got it right, Patrick.
All
But
right.
wait, before I got to interrupt you, Patrick. Okay,
Oh, there
sorry.
you go. Okay.
Yeah.
So number 7, are you at?
Okay. No, I'm not a Tony Greer style. Um,
All right.
So let's
So
talk about
listen.
the steepener because I
Yes.
always laugh. People tell me that they're bullish on fixed income, and you ask them
Like
when,
me.
where, yeah, and you're just like, I own the TLT.
You
And I'm
laugh at
like,
me. You laugh at me all the time.
well,
That's okay. I made some money on this trade, so you
you
can
did make
laugh
some
all you
money.
want.
You're absolutely right, and the TLT has done well, and it's been a great trade. And for us bears, it's been painful, and it's not been a very good trade, but. What I want to do is spend some time talking about the yield curve because there's different ways to play it, and those will actually affect in understanding how you can play the different parts of the yield curve could make you a much more profitable trader. So before we start, let's just talk about steepening and flattening. And you always hear people talk about a bull steepening or a bear steepening or a bull flattening or a bear flattening. Patrick, I think that I'll let you do this part of it. Why don't you explain what they mean when they talk about those different moves?
Right. So thanks for prepping me on this one. But
Yeah, no, I just
uh,
throw you to the wolves, buddy. Throw you to the wolves.
well, okay. So it's all about whether or not it's the short end of the curve that is the one that is moving faster than the long end, correct? And so
Well,
so
yep.
there's different ways because if the long end of the curve is running away, it's going to be the one way, and then if it's the short end coming in, it's the other, right?
Right. So if you get a situation where the bond market is up, but the short end is up more in terms of price, meaning in yield collapsing,
Yeah.
that is a bull steepening, meaning that the short end is going down faster than the long end.
Right.
And let's just take like a bear flattening. That's where the the bond market is going down, yet the front end is going down in price, meaning that the yield is increasing faster than the long end.
Right.
Now, why does this matter? Well, it matters a lot because if we go look at the move over the past week, and you talked about the fact that you were long the
Here's the two
bond market.
tens.
Yeah. You were talking about the fact that you were long the bond market and you thought you had a good week. Well, I'll tell you, the people that were long the twos had even a better week.
Well, it depends on the magnitude of leverage, though, because on a
Well,
cash
no,
basis,
because maybe on a no, because this is the point that you should be that we can trade it on a yield curve equivalent, so we can make it so
yes.
that 1 basis point is the same. So
Right.
although the bond market was up this week,
On a
it was
basis points basis, you're absolutely right. On
right
a
that
on
and then
a
and so let's go to the next. This is the slide of the TLT, which is the kind
yeah.
of the non-fixed income guy's way of trading bond market, and
Right.
and that's fine. There's nothing wrong with that, and for a lot of investors, that's terrific. Now, what I'm going to try to do is kind of open your minds to the idea that there might be other ways to play it, and this is what we're looking at now is the fact that this is this is the last month of trading in the TLT.
Yeah.
And you'll see it's run from 125 to 132, and it closed at 131 roughly. I did this as of yesterday, so just be
Yeah.
aware that that's what we're looking at. So let's go to the next chart, which is the U.S. 2-year Treasury yield over the past month.
Which I
And
can't
what you,
fucking believe this. Like this thing. I mean, we saw a collapse of over 50 basis points in a month, or near 50 basis points in a month.
it's
Like
been epic.
unbelievable,
It's
unbelievable.
dogs and cats living together kind of
Like
epic
no, no,
move.
but like I've it's under the circumstances. Like, I understand if shit was really hitting the fan, that we would see 50 basis points wiped out of the 2 year in that kind of order. But I don't really see where the bond market is getting the data from is causing them to do such a massive reprice. Like, first, I was long the 2 years, so I have no problem saying thank you very much for the profits. But to me, I was flabbergasted by the sheer amount of move that we saw. That's far beyond what I thought I was going to get.
Yeah, like we had the S&P, what, 5% from off the all-time highs. Credit spreads fairly well behaved.
This is nuts.
Unemployment unemployment sitting at all-time lows. Like there's no real,
I'm
there's
far
no
more
real.
bullish bonds than you, but I'm shocked by this. Like, like
It's even scared even you. So, anyways, let's
I'm
keep
not
going here.
scared. I'm just shocked. Anyway, but
Well, I think that you
so
guys have all talked yourselves into this.
all right,
This
all right,
no,
all right. Quickly,
honestly, I do
all right.
believe this. And all hats off to you because I've been wrong and you guys have been right. The question is whether the Fed will follow it, and this is where we're going to get into looking at what you're really betting on as you go here, and maybe you should be looking at different ways to play this trade.
Right.
But let's just keep going here. So the 2 year, go back one slide. The 2 year went from kind of where were we a week
Two and a
ago?
quarter down to 180.
Yeah, but a week ago we were 215 down to 180, and then we go look at the 10 year, and it went from 230 down to 212. So it gave up less in terms of basis points decline.
On a monthly basis, though, it gave about 50 basis points. Like, no, about 40 basis points. So we
now
went from
let's go to
245 to 205, right?
Yeah, okay. But let's go to the next slide here because I want to show. So I went and put together the numbers for everybody. So the May 28th, I'm just talking the last week. Let's just look at the last week. The U.S. 2-year, 10-year yield spread was 13.72 basis points as of May 28th. Okay? On June 5, a week later roughly, that had risen to 27.58 basis points. Right. So it was an increase of, what is that, 14 basis points roughly.
So just so that technically to express this, when I pull up the 2s, 10s here, we're talking about this jump right here, right?
Right.
Right.
So this is what I want to show you how you can play that. So let's go look at two different futures. I'm going to look at the U.S. 2-year note future, and I'm going to look at the 10-year ultra future. Now, everyone's going to ask, why aren't you using the TY future? Why are you using the ultras? And the reason we're using the ultras instead of the TYs is because the TYs, when you look at the cheapest to deliver, it's actually less than a 10-year cheapest to deliver. What does that mean? That means that the bond it's tracking is not quite 10 years, where the ultras actually have a bond that is tracking the underlying deliverable kind of bond that you deliver into that futures contract is much closer to 10 years. So it's much better looking at that as opposed to what they call the 10-year future. So Can you go back one slide, Patrick?
Yeah.
So on May 28th, the 2-year was 106 and 31 3/4 30 seconds, and the ultra 10-year future was 135 and 4/30 seconds. Kind of June 5, they both had rallied. The 2-year note future was 107 and basically a half, 16 and 3/4 30 seconds. And the ultra 10-year had risen to 136.20 30 seconds. So the ultra had actually risen more. So let's go to the next slide.
Actually, let's just pause for a second. I just want to let our listeners. So a lot of our listeners are used to the stock market where everything is now
decimals.
Fractions, and the thing is that
everything's decimals.
Yeah, but prior to, like, I think it was it was at the turn of the century, but prior to that, in the 90s and 80s, a lot of stocks actually were still quoted in fractions.
For sure.
The
I remember, Patrick. This
Yeah.
is like I remember trading eights.
Yeah,
and then
agreed.
and then teenies, which were 30 seconds, and then I don't know whatever.
So a lot of our
other stuff
listeners
was.
that are used to everything being in cents, that's not the way it was for the last century, right?
Yeah.
Like everything was fractions, and so the bond market is the last market that has stayed fractions as opposed
the holdouts.
They're,
The
they're
hold out.
holding out, and
It's so dumb. Like
and it
16 and 3/4, 30 seconds. Like
so the
that shit's stupid.
everything is in a fraction of, to the 30 to 32, and so when you hear say 107 dash 16, what you're it's literally 107 and a half, right? Because
Yes.
it's 16 is half of 32, and
Patrick,
so,
I'm proud of you that you figured out 16 is half of 32.
you know what? It took a couple beers, but I'm here. But the point I just wanted, I thought our listeners need to know, because they hear all these
No, you're
numbers,
absolutely right.
and
You're right. You're
they need to
absolutely right.
they need to know we're talking fractions, right?
Right.
Okay, so
Okay.
let's go on.
So let's go look here. From May 28th to June 5th, let's go look at the net change. The U.S. 2-year, 10-year yield spread moved up 14 basis points roughly. The 2-year note future went up 0.515625, which is basically half a dollar. And the ultra 10-year note future was up $1.50. So it
Right.
seems like if you were trading this, that the best bet was to buy the 10-year note future, right? Like that's what you basically argued earlier, was that you were better off buying that.
Well, again, it depends if you're talking basis points, or if you're talking dollar for dollar being invested in just pure bonds,
Right.
like,
And
right?
so let's go to the next slide, because I contend that idea that you were best off owning the 10-year note future was wrong. The best trade was to own the 2-year note. And the reason for that is it actually declined 27 basis points, while the 10-year only declined 13 basis points.
Right.
The curve steepened. And that was a bull steepener, meaning that the short end went down faster than the long end went down. Right. Now, let's go figure out how we trade this. Let's go to the next slide. So here, before we do that, this is the picture of the actual steepening of the curve that we see. This is the 2-year, 10-year spread. You see that it used to be 13. It spiked up to 30 even, and is now roughly 26. Let's go to the next slide.
Right.
Patrick, you there?
Oh yeah,
Can you go to the next slide, bud?
I did. It's the 2-year treasury note here.
I don't.
What do you need?
Oh shit! You're gonna have to edit that out, Lena. Sorry, write that down.
Lena, we're at the 123 mark.
Sorry, Lena. So this is the 2-year Treasury note future. We can see that the increase, it went from, those are the numbers, from 107 to 107 and a half. And then if we go to the next slide, we'll see the U.S. 10-year Treasury note future. You'll see it going up $1.50. Now,
Right.
How do we figure out the ratio to hedge between those two so that the basis point change is the same? This is where we go and we plug it into the old Bloomberg, the trusty Bloomberg, and we get this point where we work on creating what's known as a 1 basis point value equivalent. So we get the hedging ratio between those two.
Right.
And we realize that for the basis point to be equivalent, 100 Treasury note 2 years, we need to go and hedge it with 36 of the Ultra 10s.
Right.
And if we do that, we in essence get a situation where each basis point value on either the 10s or the 2s will be the same. And in this case, it will be every basis point is equal to $4,200 roughly. Okay,
Right.
You got that, Patrick?
Yeah.
I know.
Well,
I know
but let's be clear, because the thing is that this is where the debate we were having. So, like, in the end, if we're looking for the basis point, every 1 basis point to be equal to the same dollar amount, and therefore a 10 basis point move in a 2-year is equal to a 10 basis point move in a 10-year, you have to be 3 times leveraged the 2 years over the 10-year. So this is where the volatility in something like the TLT versus the IEF is so different, is because
that's right. So Patrick, 1 second, it's actually worse than that, because the 2-year is $200,000 notional.
Right.
So when you're looking at that, it's actually even more leverage than that.
Right.
It's almost like, what is that, 7?
Yeah.
7 to 1 or
6,
a little
7,
less.
1, yeah,
6, or something like that.
Well, lucky we
But-
don't have to do math for a living, right?
That's right. It's okay. We're equity traders mostly. But one of the things that when you look at this, you realize that there's different ways to play different parts of the curve, because Right now, we've got a situation where the market is running ahead of the Fed. But let's say we got a situation where the Fed ran ahead of the market. You could get a scenario where the long bond actually sells off even though the Fed is lowering rates. Because if you think about what is a bond investor's worst nightmare, it's inflation. And so there's often times that different parts of the curve do different things depending on whether the Fed is easy or is hawkish.
Right.
And understanding how to play these different parts of the curve and how to go about trading a bull steepener, a bear steepener, or even just putting on the steepener in general with no overall view is important.
Yeah.
I have long said that I think that the ultimate trade will be to own steepeners outright because the Fed will accommodate an increase in inflation and long-term bond investors will pitch it. And we've talked about this in the past. I always went and said that the 530 is the best place to play. I was a mope. I had that on I bought that and then I got rid of it because I thought that the Fed wasn't going to follow.
Well, listen, you've been on this trade for a while though, dude. Like so
that's right, but I got off of it.
Like but you only pulled it off. Like come on, you only lost 10 basis points from where you pulled it off. Well, you pulled it off in the 60s, right?
Yeah, so that was where I kind of said I think.
Yeah, whatever. You can still get back in. I mean, the point is you were long the steepener for most of this move. So kudos to you, dude. Like that's been a great trade up until then. You just chickened out a little early.
Just chickened out. But I really think that owning steepeners is going to be ultimately the best trade of this next cycle.
Yes.
I believe that this is the kind of trade that you want to own because I think that the Fed is going to accommodate and allow the economy to run hotter. And if that is the case, the last thing you want to do is own long-dated treasuries. And I think that what you'll find
I'm
is
in
that
disagreement with you. But anyway, like you can listen.
That's what makes a market. That's what makes a market.
But just to show people the thing, like back in 2008 through 2010, when the steepener on the 530s started to kick in, it went from 0 to 3. Like that's big money.
Right. And that is a lot safer trade than just trading bonds outright.
Well, it depends on leverage, right? It all depends on what the magnitude you take. But I mean, you're right. Yeah. No, but you're right. Playing the steepeners has a lot more of a hedge than taking an outright bond position. There's no doubt. I'm not going to disagree.
So I worry about those who think that the bond rally will continue and are owning long dated.
So you're worried about me.
Bonds.
You're worried about me.
I am because
I'm
think
glad
that
you care. You know what?
I think that if the Fed is as easy as kind of, I heard Raoul Paul talking about 250s, two cuts of 50. Druck is talking about the fact that we could get zero ZERP again in the next year and a half. If we get a situation where that is the case, and then imagine you combine it with Stevie's increased inflation worries, where the Fed is monetizing what we might view as increased inflation going forward. You could have a situation where the short end is actually a great buy in terms of owning twos, but the long end gets destroyed. So you need to be aware of the different parts of the yield curve, and you need to think about the fact that it might not all move as well as you think it does. And you also have to be aware there's different ways to play it. Now, I always laugh, Alex Gurovich is his idea of trading the yield curve is deciding on where he's long.
He's my kind of guy. He's my kind of guy.
Yeah, he's just well, I think the yield curve is going to steepen, so therefore I own extra twos. Or if he thinks the yield curve is going to flat.
To each their own. There's different ways of making money in the market.
I love Alex. He's a great guy. And you know what? We have to have him on one of these times. You two can have your kind of
bond kumbaya,
little kumbaya bond trades and stuff. But I do agree that you should be aware of that because if you went and this past week owned a leveraged version of twos as opposed to just a straight outright tens, you were much better off. If you own the
Yes.
equivalent, the risk equivalent
Risk
of twos,
equivalent.
you were
Thank
much
you.
better.
Because
Okay.
a lot
The,
of our listeners are just investors, and so they're thinking they're going in, and either they're going to buy 2-year treasuries or they're going to buy 10-year. When you're buying the equal dollar amount, let's say you're just an investor, you got a million in your account, and you're going to buy bonds. And if you buy the equivalent, the 10 years can have done much better. But if you're doing a risk adjusted sizing, the 2 years did much better.
well, and the other thing I would argue is if the Fed is ever as easy as you bond people want them to be, or you at Bears want them to be, let's just say that, I would argue that you could see a situation where they cut rates and the long end sells off. And I know that's crazy. I
It
know
is
you
crazy,
guys are
but
going to
it's
say
okay.
no. That's
This
that's not
show's
the.
all about crazy.
I saw Druck the other day. He was talking about the fact that QE during QE, the long end of the curve, declined in price, went up in yield. And he said everyone argues with him, but when you go look at the stats, this is what's happened. I completely agree with him. I'm going to put the chart in the actual market roundup that we send out. But if you go look during QEs, the long end sold off.
Okay. So
The worst thing you guys could want is the Fed to do more QE.
okay, but so then let me
Because
ask you
that-
something. What is
Yeah.
what's your over under on QE in 2019? Very low, right? I would imagine very low.
No, but QT I think is being bond positive.
Okay, but no,
I
no,
think
I
there's-
asked you a
I think
question,
there's-
like, because the thing is, to me, I think you're right. The timing, though, I think that there's still room throughout 2019 and maybe a part of 2020, a chunk of it, where your scenario is just not going to happen. Inevitably, by 2020, late 2020, 2021, when at some point some form of QE is up and running, then I could start buying
But
your
listen,
argument.
Patrick, they're still doing QT, bud.
Okay.
So like so you're asking me the odds of them stopping QT?
Well,
I would
September
say
they said they're
very
going to
high.
unwind. Okay, they're unwinding QT.
Yeah, so
but that's not QE.
Yeah. Okay, so but I think the fact that they're stopping is the first step, and you might find that although you would think that is bond positive, it might be more bond negative because on the
they
whole
didn't start QE until we were deep in a recession and shit was hitting the fan, and they had to dump liquidity back into the market, and they fired up the printing presses and ran it hard. And we are that in that scenario, you are dead right, but we are a while away from that, maybe even a year or more away from that. And therefore, I think you're right in the long term, but I think you're way too early.
Okay. Well, it doesn't matter. This is a great tool for all investors to have. People think they ask me, you must be being a bond trader in your previous life. No, I was an equity index trader. Bond is just math. It's not that hard. I'm going to include in the market roundup both the 210s and also the 530s hedging ratios. But there's also, I want to say one last thing. Even on on IB Interactive Brokers and Trading Technologies, these spreads of like twos versus tens, they have an actual contract that trades, meaning that you can go and trade that
I didn't even know
spread
that.
as a contract.
That's awesome.
Yeah. So if you put in ZT onto your Interactive Brokers, and then you go to the bottom where like hide or show more, there's a section where you go show more contracts, you'll see that they actually have all the different spreads.
That's awesome.
And it's actually, this spread that we're talking about is the TUX spread, TUX, and you'll see that you can trade it as an outright contract.
That's awesome. You know what? You just
Yeah.
taught me something because that's awesome.
Yeah.
I didn't know that.
And it's not that hard. I know there's a lot of people out there that are very familiar with option trading. They're very familiar with equity trading, and they're kind of hesitant to get into bond trading. It's not that hard. It's all math. And when someone says trade the steepener, it's not that complicated. You can go do it, and you can do it. There's a contract on the CBOT or the CME that actually allows you to do it. take advantage of it if you're a
So,
futures trader, because it's
all right.
something that I think that we'll see more and more as we get more volatility in the interest rate environment or fixed income environment. You're going to see that this steepening and flattening in different parts of the curve, the shifting will be huge, and this is a great tool to have in your
So,
arsenal.
Kev, I'm just going to leave you with this, and just for our listeners to know, because I want to know your opinion. Do you believe, even if it may not be the real breakout right now or not, are we going to go through a steepening cycle on the 210s? Because this thing is obviously everyone's waiting for this thing to invert. And are you still in the it's going for inversion camp, or do you think that this could be the beginning of the steepening on this, and this is a bottom on this?
Hi, Patrick. That is such a tough question, and I'll tell you why I'm struggling with it. I'm struggling with it because I do not believe that the Fed is going to follow the market down as quickly as everybody believes. The short end of the curve has gotten way ahead of itself, and I am reluctant to join the crowd that believes that they are going to cut as quickly as they think.
Hmm.
Having said that, at the same time, I believe that there's more inflation coming, and we are going to get a situation where the market will be surprised about inflation.
Yeah.
So I guess if you made me decide, I would say on the 210s, I'm unsure. 510s or 530s, I definitely think we're headed higher, and we're going to be surprised. I still hold to my prediction that before this cycle is through, before this, not this cycle, before this next inflationary environment is through, we were going to see all-time wides in the yield curve. And that is something I believe. And the
What?
only thing that
All
I will...
time wides.
Yeah,
All time.
all-time wides. Everyone is sitting around trying to buy, VIX vol, or trying to predict the end of the world in terms of equity collapse or credit collapse, just like 2007, 8. I contend that the last crisis, the next crisis never looks like the last crisis, and that it's always something that nobody is expecting. And if there's anything that nobody is expecting, it's inflation. I think it's going to come. It's going to rear its ugly head. And I still think that that's the real danger in this market. It's not another 2008. I'm more worried about a 1979.
All right, so I'm going to make my prediction. You want to know what my prediction is?
Sure. Yeah.
Okay.
Sure.
That
We're going to
no,
zero.
my prediction is that this is the next widowmaker trade, and your wife's about to be a widow.
I like it. Hey, you know what? I want to talk about my wife for one quick second. I know she doesn't listen to this, so it's no problem. But we were playing a game. We played this game called Quirkle, and it's a terrific kind of board game. And the other night that she said to me, "Oh, you want to play? I'm going to kick your ass like usual." And she's a very good Quirkle player, I must say. I'm not smart enough to compete against her. But I said, with talk like that, the market gods are going to punish you. And she says, I don't believe in your gods. I don't worship the same gods as you. And I said, well, so be it. And guess what? She got crushed. And she's like, "Oh, you just got lucky." I go, "No, the market gods punished you for that kind of cheap talk."
That's what. But I'll tell you, you know what? I do not know. I have a lot of emotions about that intro slide that you have of pictures of me, because I think that you are taunting the market gods on my behalf, and I don't know whether that counts in their
Wow.
eyes, because like I'm trying very hard to be humble.
Patrick, don't lie. You told me to do that. You made up that slide.
Give me a break. You did that slide. I know I'm that buff, but you made the slide.
No. It's just the funny part is how you're telling me how you're working out just like him, and you look just like the second slide.
Oh,
that's what I like best.
Whatever.
Okay, listen, we've gone off topic. Let's go to the next thing. Let's call it a day here.